I am back to share the best trade for 2025. This trade has me banking thousands when the market is sinking or choppy. So we are in a sinking and choppy at the same time market in 2025. And this has a lot of traders puzzled and frustrated. A lot of people who are long-term investors, they're frustrated too. Okay, so this strategy has me banking these thousands of dollars without having any money in the market at all or owning any shares. Also, if you want to see the results of one of my traders that he recently had, check out the video in the comments about AJ and his results. He made 106K in 90 days and his results were fantastic and he is thrilled. Okay, on the next slide, we're going to get into more about this trade and the market this year. So what is this magical trade? It is the bear call spread. And it's one of those funny names that they have for trades on the market. Iron condors, bears, animals. There's all these animals. Who would have thought? Okay, but yes, it is called the bear call spread. So what is the bear call spread? Let's demystify what the heck this thing actually is, okay? All it is it's two options contracts and you have them going on at the same time. Okay, so they have the same expiration date. So it's two option contracts that have the same expiration date, but they have different strike prices. The first option is a contract that we buy, so it's a call that we buy, and the second option is a call that we sell. The value of the options contract that we sell will collect more premium than the call that we buy simultaneously. So it will create a cash deposit and credit that will get deposited into our account as soon as we make the trade. This sounds also simple, right? But you're probably super confused still. And I would be too. That's why we're going to show you an example. So here's an example of a bear call spread on Amazon. So what you want to do, and the idea of a bear call spread, is to set these spread up so that the stock price, the spread is up here, and the share price is down here, and the share price never crosses through the prices of the strikes that you set up in your strategy. You want the stock to remain lower than the strike prices, and you want the stock to sort of stay the same or ideally decline in value after you set this right up. So here's an example. Okay, so we can set up a trade on Amazon where we buy the 205 strike price for $79. You'll see that I did a 24-day expiration here. I don't like doing these on weeklies. It doesn't make any sense. You need time to be right. So I like 3 weeks to 4 weeks on these. Okay, so then the next thing that we do is we sell the 195 strike for 189. Okay, you can move around these little strike prices here, guys. You can choose whatever it is that you want, but you should do one thing, and that is make sure that your bottom strike and your upper strike is a price that you don't think the stock could go to during that time period. You don't want that to happen, generally speaking, and if we're talking textbook options here. So when we buy the 205 strike price for 79 and we sell the 195 strike for 189, this creates a premium profit of $110, and that money just goes straight into our account, okay? So this trade also creates $1,000 of collateral in our account. So our brokerage is going, okay, well, if Erica really messes up on this trade, she could create a loss of $887. I think this is right here on the max loss. So we need to reserve that much collateral in her account in case she's wrong here. Okay. So notice that we didn't have to buy any shares and we are creating 110 profit, for setting up this trade. And then we just have to think about okay, what happens next here? What happens next? We should think about what happens next before we even set it up. But I'm trying to explain this to you, so let's go there. So what does it all mean? What we just did? The 205 strike call that we buy allows us to have the option to buy the shares for 205 a share if the stock rises above that price on or before the expiration date. Okay? So it's like an upper hedge, I guess you could say. The call we sold obligates us to sell 100 shares of stock for the price of 195 if the stock goes above 195 during the contract. And the most that we can lose on this trade is 887. Okay, I don't know why, guys, cut this off. The call credit spread is just happening in Robinhood lately, and it's annoying me because I would love it for it to be easier for you to read. But hopefully you're following along right now because I'm going to read a summary to you. The traditional bear call spread works when we set this spread up as the stock is declining and continues to stay down. And if the stock rises, it threatens the trade. So let's talk about this, okay? When we set up this spread right here, and we have the 205 and the 195, and our stock price right now, guys, what was the stock price that day? It was 173. So I was saying to myself, hey, you know, Amazon's 173 right now. I don't really think it can get to 195 by May 16th. And so it has to move, oh gosh, what is that? It's like $22. I don't really know if it can do that. So I feel pretty confident in this trade right now. Let's just say, and the market's declining. So I think that the market will continue to go down. Amazon might continue to go down or at least stay the same. And so I'll just be able to walk away with this $110. That would be my thesis. That would be why I would be setting this up, okay? Now, if Amazon sinks in price, the values of these contracts continue to decline, which is exactly what I want. As time goes away in this contract, or theta runs out, and we get closer and closer to May 16th, which is 24 days away, if the stock is declining and time is running out, the value of these contracts really sinks out, really diminishes. And that's exactly what we want. That's what we want to happen, okay? If this price of the stock goes up, the opposite thing is going to happen. We are going to get our spread threatened. We might see the stock come up to like 193, and we might start to get super nervous that we are at risk of having to provide shares at 185, and we don't have them. So that's not good. So what do we have to do? We would have to close this trade out for a loss, and that would suck. Okay, so again, the summary. The traditional bear call spread works when we set up a spread as the stock is declining and continues to go down, okay? Or at least stay the same. And if the stock rises, it threatens the trade, okay? So what are the potential outcomes here? Again, the stock goes down, and the value of the calls we bought and sold go down in synchrony. And then this is exactly what we want to happen. We can close the trade out when we realize a gain we like I like a 70, I love to close these out at like 70, 80% of the value. So like if it was, you know, I collected 110, I am perfectly fine with throwing the market back $20 to close that sucker out and just get it off my books. And take a lower profit, but get it done, because there's other ways other trades I can set up at that moment that allow me to get more premium from the market then. So the other option is that you can let the spread expire worthless and then collect the entire premium. So those are your two options if the stock goes down. And that's exactly what we want to happen here, okay? If the stock goes up, the value of the calls we bought and sold go up together, and the contracts of the spread all go up in value. This means that we now have to close this thing for a loss if it gets really close to 195 or over 195. And we have to kind of think about how much that's going to suck, because it's really going to suck, because we didn't take in a whole lot of money to open up this trade. We took in like $110, but I'm just telling you, if that stock gets to 195, and you are like only 4 or 5 days into this trade, for example, or even a week, and the stock goes past 195, even into 200, it might cost you like $1,500 to close this trade out. And that is really not going to be fun. Or $500, depending on how much theta's left. And so you would create a steep loss. And then you'd be licking your wounds and going like, why did I even get into this trade to begin with? Because you were wrong about your thesis about the stock going down. It went up, okay? Your other option would be to roll out this trade. So you buy to close this whole contract, and then you sell to open another whole contract that's the same trade, but different with different strike prices. But you have to accept here that you may never be able to catch up with the stock rising, and you may still have to take the loss. In fact, you may even deepen your losses. So that's not where you want to be with this. And C, you have one more option. You can trade my way, which I'm going to share with you later. Most people think that options A and B are the only actions you can take, and they are simply wrong. They are just wrong. They don't know how to dismantle and ladder out of spreads. When I trade spreads, I never think of them as spreads. I start them as spreads, and what I think to myself is, this is a spread until the spread no longer suits me anymore. And then I'm going to change it into something like else. It starts out as a caterpillar, and it can turn into a butterfly. And what am I talking about here? When I am wrong about which way the stock goes, on this trade, I am not closing out for a loss. I'm making like 5 times the gain. That's how I manage this trade. Okay. So if you're thinking to yourself, like, why do people, who don't know your strategy set up bear call spreads if the risk or reward ratio isn't great? Because we have to be right about the stock going down, Erica, right? Right? Isn't that what we have to do? And yeah, you have to be right. Okay. And if you are right, here are the benefits. The first benefit is when the market declines, we can print cash. That's amazing. 2, when a stock is trading in a range, but it's also in a decline, we can set these trades up on up days, let the normal volatility happen in the stock naturally goes down and naturally goes up. Stocks go up, stocks go down, guys. It's what they do. They don't ever stay the same. And when the market naturally moves lower, or that stock naturally moves lower as part of its normal pattern, you can often just close these out and get a really nice profit like every week or so. Like, that's why these are so compelling to a lot of people. The third thing is that we can take advantage of the high volatility the market is experiencing right now and close out 3-week contracts in just a matter of days and make huge profits. Then the fourth thing is that in a market like this that we're in right now that's so insanely choppy, setting this trade and getting in and out like two or three times a week is completely possible. I've done it myself. So it's kind of like, it's such a beautiful thing when it works out. Okay, but let's talk about the mistakes that traders are making that are making them losses here, and like how they're doing it all wrong with a bear call spread. The first thing is they trade any declining stock they see on the market and think it's an easy win. So, you could do something like a 3-month bear call spread on Tesla because it's just sinking, or AMD would be another one. They just kind of can't keep up with the market. They just keep going down. So you could just look at that stock and go, you know what? I'm just going to do a bear call spread on them because they're kind of like feeling. They're at this point in time, like the institutions don't like them, and I could just take free money here. Okay, bad idea. Don't do that. Don't look to losers. Don't look to stocks that are going down. This is like an amateur move right here, and it's an amateur move I see a lot of people making. They see a losing stock and they're like, I'm going to pile on and create more of a loss for that stock, because that's what you do when you do something like this. And I would push the value of that stock down even more, and I'm going to gang up on it. And don't do it. Just don't do it. It's a bad idea. So they look around specifically for stocks to trade this trade and this trade only. They don't know how to dismantle or ladder out of the bear call spreads, which is my secret sauce and how I manage these. They open up lots of contracts at once and get out over their skis. The stock takes off and then they fall over because they have to just spend so much money closing these contracts out. So this is a common mistake I see people making, and I get so passionate about it. If you're going to open up a bear call spread, for the love of God, don't open up 5 to 10 of them at once. Just do like 1 or 2. What are you getting so greedy about? You're going to get burned. Like, it just drives me nuts. Because people think they're like risk-free, and they're so not risk-free, okay? The other thing they do is they trade based on chart predictions without realizing charts are often wrong. So I don't trade anything with a chart. Ever. You guys are like, what? I trade up days, I trade down days. So in that respect, I know what the chart is doing a little, but charts are often wrong. So I don't rely on charts. What I rely on is backup trades. I rely on trade management. That's what I rely on. Okay, so again, the 5 to 10 contracts at once, I'm just going to go after this point. You can make, when you open up those 5 to 10 contracts, you just feel awesome because you made $500, $1,000 opening up the trades. But then the stock rockets off and you have to pay $5,000 to $10,000 to close them out. Yes, yikes, really, that's really what can happen. And traders make that mistake. And then guess what? All the effort that they went through for months trading successfully bear call spreads is wiped out in just one bear call spread. And it's so sad. I hate to see that. But like, why do I love this trade? Because I'm not making those mistakes, guys. I'm not making those mistakes. I have a very unique strategy on this trade that allows me to keep my capital in cash most of the time because I think outside of the box as a trader. And I figured out a way for this trade to work even better for me when I'm wrong than when I'm right. Yeah, you heard that right. In fact, I hope a lot of times I'm wrong. In my mentorship class, I teach people how to set this trade up, and we're like, oh, we hope we're wrong so we can make the jackpot on this one. But the jackpot isn't always guaranteed, but when it happens, it's super nice.
The other reason I love this trade is because most people in a market like this, they're like waiting for the down day and they're like, I bet you this is the bottom. What I'm going to do is I'm going to sell cash secured puts here. Okay. No, sell bear call spreads instead. Set up bear call spreads instead. And I just want to like say something to you right now. We sell cash secured puts. We sell covered calls. We set up bear call spreads. That's the right terminology for it. So selling cash secured puts makes me, this is why I don't like it. It makes me the insurance for other traders when the market goes down. This trade puts money in my pocket while it goes down. Okay. And then it also puts all the risk of the other traders that I'm selling the put to on me for the declining share price. Okay. So what's great about the bear call spread is that you're not doing that. You're collecting money from the market and you're not being an insurance policy for anybody. You're waiting for the market to retrace without taking on shares that will keep declining in value. So you're keeping your cash and you're preserving your cash. Many traders love the wheel, selling the cash secured put and then selling a covered call. That is the wrong strategy for this market. It is wrong. We are in a declining market. You will be selling puts. You'll get assigned on puts, you'll sell covered calls, and the share price is still going down. And meanwhile, you're like, what do I do now? I can't even get anywhere close to the strike price I bought these shares at. Like, I can't sell that strike because it's way out of the money. I'm making $2 on an options contract. So this is the better trade. It just is, okay? And I'm going to say that I don't like the wheel. I don't. But I have figured out a way to enter stock ownership via spreads, and I'm wheeling it my own way. I created my own wheel system. And this one's far better. And I am entering share ownership via this bear call spread. And you guys are probably cross-eyed right now going, what is she talking about? Okay. But my system makes bear call spreads foolproof. Okay. So, and how I do that is I just follow this very specific set of rules on this page. Okay. I set up bear call spreads on stocks that I want to own long term. Okay, so I never set up bear call spreads on shares I don't want to own. Never. I only trade. I don't waste time looking around for stocks that are beaten down to barrel down on, and like think I'm hot crap because of that. Like that's not cool. That's not even intelligent. I simply trade the stocks I already know very well, and I trade within their patterns. So again, as a trader, I trade 4 to 6 core stocks. I'm advanced. If you are not advanced, you probably should be working on a max of like about 3 stocks with some little accessory things going on. But you shouldn't be hunting around the market every morning looking for an opportunity. That is a waste of time and energy. You can do so much better focusing in on a select core group of stocks, trading those stocks within their ranges, and getting to know how those stocks behave. I know how to dismantle and ladder out of spreads and make them into new trades, and I bring in extra profits when I do. I open a limited amount of contracts to steer clear of greed. I don't get out over my skis. I'm not falling over. I'm not like going like, oh, I'm doing 10 contracts today. Aren't I cool? Like, I'm not trying to impress anybody. I'm trying to bring premium into my account consistently. I think I've said this a million times and I love saying it. Any profit is a profit that can compound over a 5 to 10 year period of time. Any loss is so much greater than the one you take on that day because that money is gone forever. It cannot compound. So that's why I hate losses. And this is why I love backup trades, is because any money coming into my account has the opportunity to compound over time. And that's exactly what I want to make myself wealthy and even create generational wealth for my kids and my nieces and nephews and everybody around me. That's what I want for my life. Okay, and then the last thing is I never trade off of charts. Charts are often wrong, but backup trades never are. So that's the way I look at that. So anyway, what is the system? What am I talking about? Here is my system. The first thing is that I'm always relying on great stock selection. Stock charts have to have rising 5-year and 1-year charts. I don't need to review the 3-year chart. So a lot of times you guys are going like, wait, what? Like normally you say the chart on the 3-month has to be rising too. Well, we're in a down market, so it's not going to be rising. Absolutely not. It's going to be down most likely. I think there's a couple stocks that are up right now. And Waste Management is one of them, which always impresses the heck out of me, that stock. Anyone else chime in on the comments on other stocks that are up right now? And when I say up right now, I meant like as of April 20th. Let's do that exercise. I'd love to hear from you guys. See who knows a stock that's up right now, okay? And remember, we're doing this because we're setting up this trade because our favorite stocks are trending down. That's the only reason we're doing this trade, really. I mean, when we get in, if we were working with me, I would show you another instance as to when to use this trade. That would be very intelligent. But for the purposes of this video, we are doing this trade because the 3-month chart on our stocks are trending down on our favorite stocks. The next thing in the stock selection process is that the gross profit and revenue have to be up year over year for 4 years in a row for me to want to put this trade on. And then I'm looking for industry dominators and monopolies in this market. No exceptions there, okay? If you need more info on how to choose great stocks and use a method and the method that I use, check out my Financial Freedom Through Investing series on YouTube. You can find like step-by-step process of how to do this. I often think it's my best YouTube series, but it's not the most popular. Okay. The next thing is that I'm setting up this trade at the right time. So I don't set this trade up any old day of the week. I set up bear call spreads on a day that makes sense within the price's action. Okay, and then within the stock price action and the market's price action. So that day is on up days only. So when the market's up and the stock's up, put up a bear call spread. If it's down, no, don't do that because it's far too risky that when that stock retraces, because it'll just blow through the spread you set up and you'll have to take a loss if you don't know how to ladder out of that trade. And right now you guys don't know how to ladder out of that trade. And then the third thing is proper position size management. I got to watch my position sizes. I don't set up 5 or 10 of these in my account at one time. I set up 1 to 3 trades at a time, like per stock, because that's what makes this manageable for my backup trades. So how am I keeping this profitable, guys? I am limiting the amount that I do because the backup trade that I have is actually going to be intensive on capital, and I'm going to need to have capital to do it. So therefore, I can't set up 10 because most people don't have the capital to be able to do the backup trade for 10. So that's really the reason why. Okay, and then the last thing I have to do is I have to just know my backup trades. And I don't like any trade. I don't like any trade on the market if it doesn't have a backup trade. That's just one of my ride or die rules, okay? So typically the bear call spread gives us, if we're doing this, it's because we have some indication of the way that the stock or the market is heading. And if we're wrong, we have to close out that trade for a loss. But what I'm telling you here is that with my backup trades, you don't ever have to close out for a loss. You simply have to know how to break the trade apart and create a couple of trades from that one trade. It's really the gist of it. And so what are the backup trades? Okay, here's what kind of they require. They require us to have capital, collateral, or margin available. This is one instance where I will use margin. I don't really have an issue with using margin for this trade on my backup because it's really proven over time to me to be very successful. Buying shares is going to be one of the options for the backup trade. So I have to have capital available to buy shares in that stock, and I'm going to have to buy 100 shares of that stock. So I better have the capital or margin or collateral available to do that. And then I have to know the covered call because it's essential to manage this position when I break up my backup trade. And then I also have to know the wheel or the strategy behind the wheel of getting paid to own a stock to enter it to then be able to do a covered call because I use bear call spread to wheel into other positions. So I have to understand that theory, that options theory, in order to be able to manage this trade. Okay, so now we're going to just get into, I'm going to kind of like wrap up this whole concept for you and just let you know that I always like to drop some truth bombs on people at the very end of this because I want you all to be successful and I want you to be conservative, okay? Because I do believe that being conservative takes you really to another place, a better reality, okay? I'm not conservative as a person, like at all. Look at me, I'm wearing tie-dye. I love to have a good time, okay? But I am with my money and I am with options trading. So if you don't know, the truth is like, if you don't know backup trades to this trade,
I wouldn't do it. That's going to suck for some of you to hear. Okay, but I realize some of you have been doing this trade for a while. And what I want to do is really invite you to track your trades and see if it's even profitable overall, or if you're just spinning your wheels with it or potentially losing. It's too easy to create losses here if you don't know backup trades to this and you don't know how to ladder out and dismantle these spreads. It's just too easy. So I don't like it. I don't like it unless you're an advanced trader that always is trading with backup trades. Okay, so this is an advanced option strategy that is begging for superior management strategy. And unless you have one, you're going to have to make a fair amount of gains until those are blown away by one loss. I got a typo on that page. That annoys me. Okay, the good news is that this trade is easy after a few hours of instruction. Okay, if you already know the cover call and you already know the wheel, you are ready to learn the backup trades for this and you are ready for this trade. Okay, and once you commit to learning it, it's really easy. The thing is, like, you shouldn't be doing it if you're not ready to commit, and you shouldn't be doing it if you're just trading this trade the textbook way. I just don't think you should, because it's too easy to create losses. So 3 to 4 hours of instruction time via video, and then some one-on-one time in my group calls to clarify your question on what the backup trades are is essential for this trade. Okay, I teach this trade with the backups in my mentorship group, and it is the lesson that people come out. They always come to the group call that week and say, I want to make sure, Erica, that I understand this trade. Is this true? Is this true? Is this true? And I'm like, yes, 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 and yes. You understood it. And they're like, wow, that sounds too good to be true. Or wow, that's all I have to do. Or wow, why didn't I think of this before? Yes, wow, 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 wow. Yes, wow. Okay. But people need clarity around this trade. It's complex because normally, if you are a somebody who's selling calls, puts in the wheel, your next step in options trading is probably going to be spreads. And spreads are complex. And spreads are like, but what if this happens? But what if that happens? Because there's two legs and they're working against each other or with each other. And it's, wow, it's a lot to take in. It's a lot. It's the next step. It's like your brain exploding with new information. And you need somebody to verify that with you. And you need somebody to walk you through it. So, again, I only trade trades that have backup trades. And I would only trade these with somebody that I could bounce the ideas off of and like say, hey, do I have this right? And if I set this trade up, would I be doing it right? I think that's essential for something like this. So if you want to join my Millionaire Mentorship program and up your game and take advantage of downward trending markets, it's essential for you to do this as a trader in 2025. Okay, because we are in a declining and choppy market, and you should be able to take advantage of that just like all the hedge funds are. So in the comments, you're going to see a link to book a meeting with me. Please do so. The program is going to go on for a year. You're going to learn everything you need to do. No, in 12 weeks, but I'm going to be there for you for a year to bounce any questions about your trades off of or bring any ideas to and give you feedback. And the second thing I would love for you to do is to follow up with watching my video about AJ, who was one of my traders that I trained, and he made $106,000 in 30 days and went from struggling with options to becoming profitable. AJ is not somebody who is outside the norm. This is a normal kind of result that people get in my group, and I'm extremely proud of that, and I would love for you to become one of those members as well.